I am Laura Iriarte, Head of PR and Communications at 0100 Conferences, and I am here with Volker Wende.
Correct.
Partner at SwanCap. So, Volker, thank you very much for joining us for this conversation here in Amsterdam. And first, it's more than a question. I just want to know more about SwanCap.
Yeah.
Tell us a little bit about it.
Very happy to. Look, SwanCap is an investment boutique which was created in 2013 basically as a spin-out from UniCredit, the big Italian bank, which basically is in the market in private equity for the last 25 years by now. So if you look at the team track record, most of my colleagues are with the franchise for the last 25 years, doing primary investments, doing co-investments, doing secondaries for that entire period. In 2013, we decided together with UniCredit that it's better to serve the third-party money market and basically run everything independently, being a partnership by now, being 28 professionals across the globe with offices in New York, in Luxembourg, in Milan, in Munich, and basically serving a lot of the pension associations, pension funds, and also small insurances, institutional clients, but also family offices in Europe. That's basically what we do.
Wonderful. And what would be SwanCap's key criteria when screening co-investment opportunities, which is the topic that we are trying to go deeper on?
Yeah. Investment criteria, look, there are three buckets, and we are doing that I think we did the very first co-investment in 2001, which back then was a telephone book company, which doesn't exist these days anymore. But it's always a kind of three-dimensional process. First of all, it has to fit to the portfolio, whether it's a co-investment fund or whether it's to the commingled fund product. It has to match to the portfolio. It has to match with the J-curve scenarios which we have in place. And then it's basically a due diligence on the asset where you need to have a good understanding and a great understanding of the management team, of the company, of the operations, of the markets the companies are operating in, of the competitive landscape. And the third element, the third dimension is the transaction structure where you really deep dive on where's the match between the GP, who's the lead investor in that co-investment, and the actual investment strategy. What's the transaction setting in a sense, kind of how did GP acquire that business? What did he pay? Who else was in the competition? So really having a good understanding of that transaction process in parallel to that.
And what will be the primary risks and the benefits for LPs seeking direct exposure to portfolio companies?
Very good question. I think the key risk is a bit the same like any other GP. You can lose your money. And that's the idea of you have to create a portfolio, you have to diversify, or you have to lower the risk by a simple diversification. The bigger the portfolio, the better it gets, but the bigger the portfolio, the lower the returns. So you have to find the optimal diversification of that product and also communicate that fairly transparently to your LPs. What are the benefits? On the one hand side, you typically invest without fee and carry, so you get a slightly higher return. You can shape the J-curve, so compared to a primary fund, it's probably invested a bit faster, and with a higher return, you can squeeze the J-curve in that product. You can put a bit more exposure to a certain sector or to a certain region or to a certain GP. And I think last but not least for us as a kind of long-term platform, it's a due diligence element. When you invest for a 5-year period with a GP, you learn what he's doing good, what he's not so good, basically how he treats the interactive parties, starting from the management to the banks to the co-investors. It's a kind of 5-year life due diligence on a GP, which is a great experience and which is also kind of factored into our new primary discussion when it comes to that point.
And in your case, because you mentioned some risks and benefits, but you have over 150 co-investments to the date, no? And how do you structure these opportunities and how do you optimize them in terms of managing risks and getting returns?
Yeah. There are two elements which are important to that. The one is the diversification, which I already mentioned. You have to diversify across the different sponsors, across the different regions, across the different industries, just to avoid any cluster risk around that. And the second element, which is, I think, very important, is the team element. You have to have a dedicated team which knows how to do a deep dive on the investment, on the one hand side, but also a deep dive on the sponsor. And last but not least, you have to have a structuring and compliance team which is well aware of the different processes. Because next to these 150 co-investments, they were done alongside 70, 75 GPs, and all of them have different requirements, have different hopes and different expectations on the process. And you have to be in time because you have to understand syndication and the co-investment process is not the core of the business of a GP. It's more the investing, and you have to make their life as easy as possible.
And going more into SwanCap's specifics, no? Because you mentioned some structures, but more on a general, level. But when you talk about SwanCap specifically, are there specific sectors or markets, where you are particularly strong? Do you have a strong network of sponsors?
Yeah, we are, as mentioned, in the market for the last 25 years. We are only doing private equity, only buyout, only Europe and North America. So our network of GPs, I think, currently spans 100 to 150-ish sponsors with a broad range of kind of shadow portfolio, which we monitor. If you look at our co-investment portfolio in specific, it changes over time. As mentioned earlier on, our very first deal was in the telephone book sector, which no one would do these days. So you are basically mirroring what's in the market, and that's the charm, if you want to have, of such a product. You get a condensed version with a good diversification, with a second look from an experienced sponsor. We don't, in the end, need to be a sector specialist like many of our GPs, because we can partner with the right GP for the right asset. So finding that good mix. And for us, our key benefit is developing a portfolio and selecting the right opportunities, creating the opportunity set to select from to create an alpha for you as an investor.
And how do you select your GPs in Europe and in the US, and what will be the difference? What are the characteristics or specifics of European GPs versus your GPs in the US?
I think there is not such a big difference. Europe has the specialty that you have the different jurisdictions compared to the US. You have one big legal and regulatory scheme in the US. Whilst in Europe, you can select the regional funds, the local funds, which is probably the key differentiator in the portfolio. So in Europe, if you look, you have Spanish GPs, French GPs. In the US, it's just one big market where you can go a bit deeper and go into a B2B services specialist fund, which probably doesn't exist in Europe.
How does the SwanCap integrate ESG considerations into the decision-making process when it comes or before co-investment?
It's definitely a parallel process. So our due diligence next to the commercial and the legal process is also an ESG review. We have our dedicated experts based in Luxembourg, which are reviewing the ESG, the sustainability reports more and more. And this is a process which probably started 5 to 10 years ago, or five at least, where you have dedicated ESG reports also on the buy side, but also on the sell side, which you can review, where you can form a view. Our experts in Luxembourg on a regular basis sending out questionnaires to all our GPs, also the co-investment GPs, to track the development and also push the kind of improvement of those processes. So it's well integrated, and it's not a new phenomena which you use it in marketing. It's really embedded in the investment process.
And how do you deal with the American GPs, for example, or they have a different concept of ESG?
A bit more different, especially when you are ramping up a fund of fund where you have a bunch of different products. The US is a bit more focused on gender diversification, whilst the Europeans are more on the economic side of things. It's tricky. If you deal with a more mid-market plus, so mid-market, large cap sponsors, all of them are fairly equipped with the requirements of the European ones. For the other players, you just need to ask them to fill out the questionnaires. It's less structured. Fully agree.
Wonderful. Well, and as one of the most experienced co-investors in Europe, and with this 20 years of experience, basically, right? And how have you seen the co-investment landscape evolving in the recent years? And what do you see it's going to happen, like in terms of trends, in the near future?
It's a very good question, because we discussed that right in the panel already. And look, it came in waves. If you look 5, 6, 7 years ago, everyone was asking for co-investments. And you had a bunch of don't want to use the word stupid money, but kind of cheap money, with very unstructured strategies in the market, kind of doing a co-investment here, then pausing for 1 or 2 years, doing a co-investment there, which is, in my view, not a strategy. If you look at the more institutional players or the more professional players, I think the competitive landscape consolidated a bit. You still have a good bunch of fairly good players around, which are well interacted. So I'm not afraid of that market development. I think the core of the professional players are still around and will be around. The key risk of that market, in my view, is the cheap money out there, which is replacing the co-investments. But in all honesty, the relationship element of a co-investment is now well reflected both by the LPs, but also by the GPs. It's a good cooperation, and you know that there is a diligence element, which I described early on, not only for us as an LP, but also for the GP, who then knows that if you offer the co-investments and if you cooperate together, it's a longer-term partnership. In the end, it's people's business, and you need to convince each other counterpart that you are the right player to deal with for the next 10, 15 years.